You're listening to the Stock Detective Podcast. I'm Kermit Capital. On this episode, Dhaval Kotecha interviews Ram Bhupatiraju. Ram is an engineer by trade and has many years of investing experience and insights to share. Ram is active on Twitter, where he's known for his detailed scorecards outlining the investment thesis behind many of his holdings. You can follow him on Twitter at Ram Bhupatiraju. Now, before we get to the episode, here's a quick disclaimer. This podcast does not constitute an offer of or solicitation for purchase or sale of securities or provision of any investment services. It is provided for information only and should not be considered as investment advice or recommendation to buy, sell, or hold a particular investment. You're responsible for your own investing decisions. All right, here we go.
You are listening to the Stock Detective Podcast. I'm your host, Dhaval Kotecha, and today we are joined by a special guest, Ram Bhupatiraju. Ram shares a lot of his learnings via Twitter, and I have personally learned a lot from him since I started following him almost a year back. His Twitter handle is at Ram Bhupatiraju, and he is a must follow if you're not following him already. Ram, thanks for joining us today. I'm very pleased to have you here and excited to have a conversation with you.
Thank you, Dhaval, for that very warm introduction, and I'm very excited to be here and talk about investing.
Great. So, to kick things off here, can you talk us through your background and how did you start investing?
Sure. So I am an engineer by my education and by my career background, and I work in telecommunications where we provide engineering services to various providers in the United States. So it's purely an engineering role and not that much overlap with what I do with the investing part of it. So coming to the specifics of my investing journey, I just want to break it down to like three parts. Initially it started in 2007, but I want to go through these parts where to explain more about why I'm passionate about investing and my journey from 2007 until now, and who are the people that influenced me the most when it comes to investing and who I learned from the most.
Great.
I just want to explain why I'm so passionate about the investing part of it. So I look at it initially as a combination of businesses, numbers, and psychology. So to explain a little bit further, right? So if you're a listener and a very close observer of the various businesses that are around us, right? So you get to observe the world in a much different fashion, right? Normally, we are just used to looking at everything as a consumers. And when you look at it from a business and investing perspective, I think things get a lot more interesting. So you just get to observe what are the major ongoing trends that are going on in the world, which companies, which industries are leading us into the future, which companies are delighting their customers, who are innovating the most, and who are the leaders of those companies and what are their ideas and stuff. So I just like to know more about what is happening around, right? The second part is the numbers. So being from engineering background, we're always very curious about numbers. So when you come to the financial statements, how you interpret them, how you analyze them and understand them, and also the valuation part, right? What sort of valuation techniques do you use and stuff. So trying to get better at the numbers part of it is also a big challenge for me and an interesting part of it. And the third part is the psychology, right? The behavioral psychology. We know that markets are driven by cycles in the longer term, and there's always the fear and greed in the markets. And also, we are all impacted by these behavioral biases, right? Whether it could be anchoring or endowment effect or confirmation bias and tons of biases, whether or not we are completely aware of them, we are impacted them over the short, medium, and long term. So it's useful to understand how you're getting impacted and what you can do to improve your overall process, and that will improve your investing results, right? So always look at it from that perspective. To be a good investor, at least I try to be continuously get better at how you look at businesses, how you analyze businesses, and how you understand numbers and application of the numbers part of it and the behavioral psychology, both from a market perspective and our own individual perspective. So going back, rewinding, so I started investing in 2007. I'm still an individual investor from then on. So I initially got started like most of us in non-financial background would get started, right? You either see a friend or a family member talk about stocks and you're curious and you want to make some money on the side, right? So I always think about this when you initially get started and without a financial background. So your desire to make money from the stocks is usually up high, right? And your confidence levels that you can make some money quick is also up high. But our actual ability to understand what the markets are about, how to understand the businesses and the numbers, and to follow a good investing process, that ability is low. So obviously the discrepancies will reflect in the numbers pretty quickly. So back in 2007, of course, I wasn't investing in penny stocks. I was sticking to tech at the time, at least Cisco, Garmin, Research in Motion. Uh, um, some of these companies were pretty popular by then too. So all we know is just the stock and the stock symbol and the price, right? I didn't know much else, right? If it is going up, I buy a little bit and let's see if it gains a little, I sell it. So that went on for a few months, and this is October 2007. And just to give you a brief background, that is a peak for the pre-recession peak for all the indexes, October 31st, 2007, right? So I was invested in a company called Crocs at the time, and the same day it gave some bad results, and the stock got cut in half, I think. And although I have very little capital at the time, that did impact me, right? Saying that the stocks could lose half their value, and especially if there isn't much supporting them in there. So that kept me away from the markets, which was a good thing because, as I said, that is the peak of the market. And since then the bear stance happened, and September 2008, everything came crashing down. So that one experience from Crocs that kept me away from the market was a blessing in hindsight. So around 2008, when everything was going down, of course, being from non-financial background, I didn't know what was happening, why markets were coming down, and I didn't know what great default swaps were or mortgage-backed securities were and all that stuff. So around the same time, I was lucky to read I think this was a graduation presentation from Seth Klarman to Harvard or MIT back in October 2007, right? But I read it in September 2008. So that single presentation did change my mindset a lot. But in that, he clearly explained 1 year ago, he explained what was about to happen, right? And how when investors pile up without knowing the risk reward portfolio and how that can get out of hand, and when tide turns, yeah, how everything could come crashing down, and how you're supposed to follow some basic investing principles and look out for safety and stuff. So I was very interested and impressed by that letter, and which kind of changed my mindset. And that's when I tried to do more research, and obviously that'll lead to, like for many people, it'll lead to going to Benjamin Graham and Peter Lynch and Warren Buffett. Late 2008 was when I read all this material, and it was also a good time to buy everything cheap. All the good stocks were pretty 70-80% down from the peaks. All the bad stocks were even more, right? So so the first phase, as I said, was 2007, and the second phase is 2008 to 2012, let's say, right? And this was a phase when I was buying everything, trying to buy everything cheap. That is the first main focus, right? Whether or not they were quality companies for the long term, I didn't know at the time yet, but I was focusing too much on financial statements and how much they fell down, and looking through that 52-week low, because pretty much everything was at 52-week low. This is the great financial crisis. So at least there was some improvement from the phase 1 to phase 2, right? At least I was looking for value, trying to understand the companies and so on. So coming out of the recession, it was some of them picked up a lot, and that also gave me some extra overconfidence, which you shouldn't have. So I went into some options and stuff, and I did, at least in the options, I was being very careful. Again, there, I was only doing leaps, and I was trying to understand the companies. But unfortunately, 2009 to at least 2010 to 12 weren't exactly rising markets. They were pretty flat. So some of those leaps expired, worthless, and so on. So anyway, I took my lessons from that phase, saying that okay, buying cheap is okay, but you need to look for something more, right? And also options, time always works against you and stuff. So the third phase I would describe as 2000, let's say 2012 to 15, where I was like, okay, it's not just a matter of buying cheap. You want to buy profitable companies and stuff, right? You want to buy good companies. That's when it led me to some good companies and some other companies. I went into Coach, Whole Foods, and a bunch of other things because the previous 3 years from 2009 to 12, they had a lot of appreciation and they were profitable. They had very little debt and so on, right? So 2009, 12 to 15, the phase and the lesson I learned later from that phase was it's good to be profitable, right? It's good to look at good balance sheets and stuff and trying to get a low valuation. But you also need to look at the future, right? If the future isn't as great as before, obviously the business results and the stock value will follow. So finally, I'd say 2015 to now is where I moved to the fourth phase of my personal investing career. So in 2015, I read more with Clayton Christensen and all that material. So that kind of focused me on, in addition to the focus on value, profitability, balance sheet, how you need to always be looking forward, right? So think about the future, how these companies would adapt to the future and so on. So overall, yeah, those four phases, I'm happy to take away some lessons towards that. And obviously it's a continuous journey, right? That's always, we're trying to improve and so on. So the third point I want to talk about the investing journey is investing influencers, right? I mean, in the world of investing, there's only very few original ideas, right? The rest you learn from the great people that came before you and learn from your peers or those who are good with investing. So I had 7 or 8 people. I just want to briefly touch on that. I don't want to go too much in detail, right? So I want to go in chronological order. Again, I'm trying to gear more of this towards the newer investors who can take a lot more lessons. So I'd say the person that influenced me most, again, coming from chronological, was Benjamin Graham, right? And of course, we know the concepts, right? About the intrinsic value, margin of safety, and Mr. Market. Those are the 3 takeaways, right? That taught me that stocks are supposed to have some intrinsic value, whether or not you can correctly evaluate it. Some businesses maybe you can get, and hyper growth businesses maybe you cannot yet, and so on. But at least logically, there is supposed to be some intrinsic value. And when there is a big discrepancy between the current value, market price, and the intrinsic value, is where you have an opportunity. And similar thing for Mr. Market, right? And there are occasionally periods when everything will go haywire, and that's when you're supposed to be calm and analyzing and make sure you're doing the right things for your long-term plans and stuff. So those are the lessons I took from Benjamin Graham. And the next one is Philip Fisher. We know that the Common Stocks and Uncommon Profits, it's a great book. I can't believe it's written 60 years ago, and it has so much lessons for even growth-oriented investors even now. So the main thing that I look from his writings and teachings for. So again, how to think about the future, right? What is this company doing? How to evaluate the quality, the management, what are the exact products, and how their R&D and sales is helping them and to lead them towards the future and so on. And especially when you're invested in good stocks and you had a good thesis, you need to hold that for a very long term. That's one main lesson. And the next one was obviously Buffett. The main lesson I learned from him was when you think about investing as investing in the entire business, right? You tend to make decisions more deliberately. You tend to learn a lot before you just buy a stock randomly, right? So that single lesson will change your whole concept on how you're trying to approach investing. And then Peter Lynch, and simple. It's try to understand what you're investing in and try to keep things simple, right? And it's a great point to take away from his. And from Howard Marks, again, he has great memos, and the main points I learned from him were how to think about market cycles, right? I mean, especially we are currently in an exuberant cycle, I would say, at least coming from some sectors, right? In many cases, the business growth will warrant that prices, and in some cases they wouldn't, right? But at least you need to be aware that how the overall market cycle could influence the psychology of the investors. And when things start to go down, how it will eventually change everything and so on. So you need to have some appreciation of the cycles, which will attribute enough to luck and your own factors. So, and also Seth Klarman, the main thing I took away from him was how you think about the downside also, right? And that's the reason I focus on the balance sheet also. I just don't want things to blow up when you're looking to the upside. And the two last folks, I would say, were Clayton Christensen, and you're familiar with his book, The Innovator's Dilemma. It completely changed how I think from purely backward looking financial to forward looking also. So you need to be aware of where disruption is going on, where innovation is going on, and where the growth is going on, and if and how it will impact the companies and sectors that are not adapting to it, right? So, and the last one would be David Gardner from the Motley Fool, actually Tom and David Gardner, right? And especially David's sayings where you try to find excellence and hold excellence and buy more of excellence, and having a vision for the world and investing accordingly and adding to your winners and so on, right? So as I said, it's a combination, right? Whatever you're trying to learn, it's a combination of what information you're trying to absorb from the great investors and peers and everyone. So yeah, overall, that's the overall investing journey I want to touch base on. And we can slowly move on to my research process and so on.
Yep. So great. So what I see is you learn from these influencers, and then you post on Twitter and share that information with everyone on FinFit, right? And I also see that you post a lot of graphics about the stocks you invest with your comments on each of them. And so I just was curious to understand, like, how did your research and what was your research process, and can you talk more about your investing framework?
Sure. So for the research process, right? I mean, as I said, it evolved from back from 2017 to now. So usually I try to go by some broad principles, right? These are like the guardrails of my investing, right? And these are always going to be there, right? And everything, the specifics I operate are usually they fall within here, right? So once you have those boundaries and clear definitions of the long-term principles, right, it's easy to stay within them and then do everything else that you want to do, right? So these are some of the few broad principles I believe in and will stay for the long term. Right? I mean, the first thing is markets go up over the long term, right? We don't know what's going to happen in 1 year, 2 years, 3 years. It could stay flat, it could go down, right? But if you zoom out long enough into 10-year time frames, they always go up, right? So although it doesn't look like that in the bear markets, they always recover, right? That is a basic principle we have to believe in, right? If
Right.
you're investing. And the next one is the intrinsic value of good businesses will go up, right? Stock prices, right? It's a different matter, right? That's the second step. But the actual intrinsic value, if the company is building value, right, towards its customers, towards its employees, and the whole ecosystem, right, and it's getting better and bigger, the actual intrinsic value will go up over time, right? Let's say in a 3-5 year time frames, right? So the next thing is the market volatility, right? And the bull and bear markets. It's a given, right? We don't know when volatility will get hit and how deep it will be. It could be like the COVID period back in February and March, where there was a 35% drawdown and the VIX went up to 80s and 85s, right? And even in a normal year, there are always bouts of volatility, right? We just have to be prepared for that. We have to expect it and prepare for it, right? And your plan could be as simple as, okay, I know it's going to happen. I'm going to stay invested. I'm going to continue my contributions and continue to invest in good companies or the indexing and stuff, right? So you just have to expect it and not to be surprised every time it shows up. The next thing I try to remember is the different players in the market, right? It's imagine it's like a stadium, the market, right? And there are tons of different types of people coming in there, right? There are long-term investors, right, who are trying to buy it for 5-10 years and so on. There are momentum investors who are just following the stock and so on. There are traders who are even shorter term. There are option traders and stuff, and or who are short selling. And so there are bunch of different players, right? And they could be coming from their aspect and saying something on the TV or wherever, Twitter or somewhere, right? So it doesn't matter to you, or it only matters to you what your understanding of that company is or that sector is, and what you want to do, right? And so it doesn't matter what a short-term trader is saying or a momentum trader is saying about the stock, right? If you have a different perspective and if you have a much longer-term perspective, have that and give more importance to that rather than what else you're saying. And the next thing is liquidity, right? We had to remember the stock market, right? It's a great way for small investors, big investors, everybody, creating that liquidity for you to take part ownership in great businesses that are building great features, right? So that is a good part, right? But the flip side of it is everybody can do trading every day, every microsecond, right? So you have to be aware when liquidity helps you, that is to get into the good businesses, and then it could hurt you if people can sell for any sorts of reasons, just because of macro environment, just because of disappointing earnings, whatever, right? So make sure the liquidity benefit for the other people is not impacting your thoughts of how to think about that particular stock. So these are the broad principles, right? And markets go up over a long time, intrinsic value goes up over a long time. There's occasional periods of volatility, bull and bear markets are part of it, and there are all sorts of players in the stock markets, and liquidity can be just like leverage can be a benefit, or it can be a big problem too. It depends on how we put them in perspective. So those are the broad principles, and we can go into my specifics of how I do. So as I said, initially back maybe in 2012 or so, I used to start my research process from a screener, right? So it could work for some people, right? But at least what I used to do is look at a screener, and something I was focusing on very cheap stocks, as in not necessarily price to book, but price to free cash flow and so on. But I was insisting on less than 15 or so, let's say, right? And some sectors show up, right? Let's say 5 different companies show up. And I was forcing myself to do research on them, even if I was not interested in that sector, right? It could be in hospitality business, or it could be in the healthcare business or something, right? So I was trying to learn a completely new industry, and trying to learn about the companies from the 10Ks, presentations, and all sorts of stuff. There's a lot of confirmation bias there, right? You started your research process saying that, hey, this is a cheap stock, maybe I want to invest it. And when you have that perspective and you're trying to force yourself into doing some research, right? And you tend to ignore what the problems are and just trying to validate yourself, saying that, oh, I got good enough points and let me go ahead and invest, especially because it's a cheap stock. And in, like, I'd say 60% of the scenarios that didn't result in a good outcome, right? So overall, since reading Christensen and David Gardner's lessons and a lot more, and so I was trying to take a more top-down approach, right? Again, this comes from curiosity to see what is happening out there, right? Which particular sectors and trends are gaining the traction? Is it technological trends, consumer trends, demographic, regulatory, and so on, whatever it could be, right? So at least you'll be oriented towards those trends, and you can learn more about them. Why, let's say, cloud computing or something, you can learn more about it, right? And then it'll lead you to what are the companies winning in these trends and who are the innovators leading those companies in those trends and what's going on. So I started to take more of a top-down approach, as I said, and currently my favorite sectors would be, again, technology, and specifically SaaS, e-commerce, and in finance it's more fintech, and in healthcare it'll be more medical devices. And I do like a certain category of consumer oriented companies if they have the brand recognition or ongoing providing ongoing value to the consumers, right? Let's say Disney, Starbucks, and so on. So once I started taking that overall macro view, at least it benefited me more, saying that instead of getting into some value traps, you're trying to move or focus towards the areas which are growing and which are creating real value out there in the world, right? Let's say, and then moving on to the focus on the specific things, right? So the first thing I focus now is the revenue, right? Try to understand as much as possible in the revenue. So let's say, what are the products and services the company is having, the distribution of those towards the revenue, and the customer concentration within the revenue. Is it a recurring nature versus a one-time nature? And so because if the revenue is growing a lot, that will actually tell you multiple things, right? Saying that the company is getting traction, customers want to buy more of it. Why do they want to buy more of it? That's when you'll find more interesting things, right? And we often overlook this advantage for growth companies, right? Growth companies do not have that balance sheet. Is most of their investment is not from balance sheet but from income statement. So it'll tell you gaining all that additional revenue, they can put down to a lot of things, right? I mean, they can try to reduce the cogs and improve gross margins, and they can contribute towards R&D, sales and marketing, and so on. So it will give you a lot of leverage what you can do. So focusing on the revenue, right, is very important for. And then look into the quality, right? When you say quality, what is the sustainability of that? What is the durability of whatever we're talking about, right? And similarly, mode, right? We are familiar with the different modes, network effect, switching costs, and scale, and and so on. So again, more for technology companies, you'll come to network effects and switching costs are very powerful. So if a company is building that, you have to be understand what is causing it and what is the direction of the mode, which is very important, right? Is it emerging, widening, or decreasing, and so on. And management, obviously, who are the management, and learning more about how the company started. If it's in the last 10, 15 years, it will help you. And because if the company started from perspective of solving a problem from the founder, and especially if that is a big enough problem out there in the world, that can create a lot of value, right? So if you're solving actual problems for your consumers and adding adjacencies into your product line, that can get very big over time. And competitive landscape, of course, there's always present. If you're attracting a lot of revenue, if you're attracting a lot of margins, you are going to attract competition, right? So it comes back to modes and management and execution style, on learning more on what could help this company keep its distance from its competitors and continue to lead into the future. And for some of the slightly more mature companies, of course, looking at return on invested capital and how it's evolving over time, right? So if you study like Buffett or Chuck or Terry Smith or most long-term investors, right, you'd come down to the same main points, right? They want a good business which has some competitive advantages, some moats built in, and they want the good balance sheets, and they want good management, honest, able, and with people with integrity, leading the company for long term. And they want good return on invested capital and the ability to invest that capital back into the business, and thereby seeing the long runway. That could be a huge growth machine. Right? So those are the 4 or 5 main points that most of the long-term investors focus on. So once we get better at those, that will eventually result in better and better outcomes for our portfolio. Coming to the financial statement analysis, the main thing I learned after many years was you have to be able to interpret what that financial, okay, understanding the financial statements, of course, it's a given, right? Even you investors with a couple of months of studying, they can understand what is the structure of financial statements, what is the income statement, what are the components, balance sheet and cash flow statement and shareholder statement, and so on. So the main thing is to understand how the income, all the financial statements change by the industry, right? And then based on the company's growth and life cycle, right? So if the company is growing a lot, of course, its income statement is the revenue top line will be growing, but the bottom line, maybe it's still spending a lot. It will not look that great. Cash flow, operating from cash flow might look decent, but there could be problems in other areas and share-based compensation and so on. A balance sheet, there isn't that much assets, the physical assets and so on, but unsold. So you have to be able to understand the financial statements by industry, right? And then based on the growth life cycle of this company. And the main thing is what story are those financial statements trying to tell you? That's the most important part, right? Not just reading the numbers from that financial statements, but What is the story? Does it correlate with what you were expecting? And how to check it on an ongoing basis, right? That's the biggest takeaway, right? Try to put it into context, the financial statement. Similarly, for valuation analysis, right? People usually start with price to earnings and so on, which is reliable, which is a good metric, but price to free cash flow is, I think, is better. But again, when the company is just growing and they don't have free cash flows, what else do you look? All right, and so when to use price to or enterprise value to sales, when to use price to cash flows, when to use price to book, maybe for financial companies, when to use the dividend based metrics for stable dividend based companies, and so on, right? So if for, let's say, if you're very interested in a huge growth company and you understand its context and everything, right? And if you expect the price to free cash flow below 10, it might not have any free cash flow for many years, right? And unless in a huge GFC type scenario, the free cash flow price, the valuation wouldn't come down. So what do you do in that context, right? So those are the sorts of decisions we have to make, right? Which valuation technique makes sense more to this business, and to decide when you do not want to pay up versus when you want to pay up, and so on. And finally, the business and value drivers, right? I mean, if you're really doing it for the long term, for each business, you have to, it comes down to like 4 or 5 factors. What are the really important factors that drive this business, right? Uh, let's say for a subscription based business, of course, it's your retention and how your dollar based expansion and retention metrics and so on, right? And how cheaply you're acquiring these customers versus their lifetime value and so on. So for a retail industry, it could be something different. How your sales, sales, same store sales, and so on. So you have to understand the context of what are the main drivers for that particular industry, and especially for that company, and they might or might not be reflected in the financial statements, right? So you have to get a story for get a feel and story for that, and the initial thesis, right? And so let's say you made the decision to invest in this company now, right? At least I try to answer a few basic questions, right? Why out of the, let's say, 3,000, 5,000 companies out there, why are you choosing this company, right? So you have to be able to understand, explain it in 1 or 2 simple statements, right? So, and let's say you go into Square, right? You say that, okay, they build the ecosystem on the consumer side with the Cash App recently, and they already have the ecosystem from the small business side for built over a few years, and now they're connecting, trying to connect both of them, which could result in a flywheel down the road, right? At least something as simple as that. Why are you investing in it now, right? And why now, right? And so it could be as simple as maybe you didn't have a good understanding of the company before, or maybe some news came to light, or some good results came out recently, or you're waiting for a better valuation and it finally is there, and that's the reason you're in one. So it's important to understand why are you investing in this particular company and why now, and decide on few criteria that will tell you how the investment thesis is going on. It can be like 30-point checklist. It will just have to be 3 or 4 major items, right? That will tell you whether the thesis is evolving correctly or if it's getting sidetracked and so on, and what would cause you to sell. So having an overall idea of that will minimize, or at least reduce you how much maintenance, due diligence that you'll have to do, and so on.
Right.
Okay.
So after this entire research process, you decide, okay, I want to jump in a company. So you would have like had to add a lot of companies to your portfolio. So how do you kind of manage your portfolio? Like, do you kind of like, how do you know how much big a company should be in your portfolio, or like how do you kind of effectively manage it?
Okay. Yeah. Great question, and a very important one. So again, this evolved over time, and as the first thing is the hurdle rate that I put for the companies to get in, right? And once you take up that quality hurdle up, and that will minimize your chances of blow-ups a little later, right? That's one main difference that I did, right? And individual stock analysis is good, important, obviously, right? But from a personal perspective, you're more interested in how the overall portfolio is maintaining and growing and so on, right? So as much focus as you put on the individual stock analysis and when to buy and stuff, you'll have to also look at what you're buying and what amounts and how you're doing your portfolio rebalancing and stuff, right? So you need to have a certain criteria for what types of companies you're buying and what are the criteria for your holding and when you would be selling, right? So from personal perspective, most of my holdings are pretty I try to buy it for the long term and invest in only good businesses that I understand. And most of them are in growing sectors with great management and very little financial risk and so on, right? And very rarely I do invest in valuation driven purchases, right? I mean, I still like those companies. Those are still good companies, but the stock got cut in half with no apparent reason. This did happen during the COVID time, right? To just give a few examples, maybe let's say Uber or Anheuser-Busch, Budweiser, and Brookfield Infrastructure Partners. Again, some of these are great companies. Some people will want to hold it for the long term, right? And I was having it in my watch list and not necessarily at the top of my watch list because they don't necessarily have that much growth, at least for Budweiser and Brookfield. But the stocks got cut in half and more than half, right, because of COVID, right? Some of that could be warranted based on the company specific cases, but each individual investor have to decide, right? Is it really worth a 60% haircut for the volatility driven by a macro factor when the company is built for long term, right? So when those factors fall in, I do buy those sorts of companies too, but those are usually short to medium term, right? And once I think they come back to their rough range of intrinsic value, I usually sell them, right? But the rest, 80%, I would say the portfolio is pretty long term. I bought them for a reason. As long as the thesis is going on, I hold them. And when you trim is again a very personal choice, right? And so also within the portfolio, you have to decide the periods of volatility are always going to hit, right? So you have to be ready, right? So the sorts of approach I take to volatility, right? Let's say we are at the very high range, right? And we know that, okay, most businesses are priced, some of them are priced for perfection, some of them are pretty high and so on, right? And either some people might decide to, you can hedge if you are good at it and know a low cost way of doing it. But the way I approach is that, right, these businesses are built for the long term. There's no financial risk that they'll blow up, right? So the stocks might go down 20, 30, 40%, right? I don't necessarily sell them because of expecting something, right? But the new cash that comes in, maybe I might be more conservative, right? Maybe the market's look too elevated. Maybe I'll slow down my buying into good companies and wait for a better period and so on, right? So also deciding when to sell is a very important and very personal endeavor, right? I mean, if you bought the company for a specific reason, you have to try to stick to that reason, right? And if there are two types of scenarios, when things did not work out as you expected and things did work out as you expected, right? When things did not work out, it could be like few things of you were completely wrong in how you analyze the company. And if that becomes apparent, mostly you have to sell, right? And the second scenario is you are right in assessing the company at that time, but things change for something bad later, at a later period of time. So you have to evaluate those facts and make that hard decision that you'll have to let it go or something. And the flip side of it is things worked good or things worked beautifully, right? And in those scenarios, what do you do? And from my experience, what I learned is if things are tracking along okay, you should hang on, right? And if things work too beautifully and the stock that you bought for 5% blew up to 40% of your portfolio, and if it's giving you sleepless nights, I mean, if there's a lot of future growth ahead for the company and it looks as good, I don't necessarily sell, but usually I prefer to trim a little bit down to your peace point, I guess, to the level you're comfortable, right? So those are some criteria I try to follow with the buying, holding, and the selling. And when the initial allocation part of it, right, I believe in that method of buying in thirds. When something is very attractive, it looks really good. I try to eventually it could be at a cost basis it could be 3 to 5% of my portfolio. But usually, unless stock got beaten down severely, like during COVID or other volatile periods, I try to buy it in thirds. I buy one third of my amount I want to commit, and then see how its thesis is moving along, how the company is performing, and their quarterly results, and so on. And also, you get more understanding, right? Once you have skin in the game, you understand the company more and look at what are the actual metrics that drive the business. And so, if things are tracking along, maybe add a little more and get to that full position. Sometimes I don't get to that full position, but that's okay because there are opportunities in other companies being created.
Right. So,
Uh, yeah.
so how much typically a cash position you have in your portfolio? Because that seems to be like when you are buying opportunistically, you probably have a certain amount in cash all the time, right? Or is that not the case?
I mean, some of these accounts, right? It depends if it's your retirement account. There's always cash coming in, right? You don't have it right now, but maybe 3 months down the road, you'll have more accumulated and so on, right? So I try to keep it not too high, not too low. Again, it changes. Sometimes it could get to 20%, back in early part of this year. But when the scenario like COVID hits, obviously you will allocate more of the capital and so on. Again, this is not a particular recommendation or anything. It's very personal. So it's also it's a lot different once you're a professional versus you're a personal
Right.
investor, right? In a professional, you cannot, you should not maintain that levels of cash flow unless you have that real flexibility with your investors and so on, right? That's a huge opportunity cost if you're in 30% cash for 2 years waiting for opportunities, especially for professionals. A personal investors, it's a personal choice, right? You learn and you evolve and do it. So yeah.
All right. So what we could do is we can talk about your favorite companies, and I'm pretty sure you would have a lot of stories to talk about them because you have been investing since last 13 years. So can you go through your investing journey and pick your favorite companies and talk some stories about it?
Definitely. One of my favorite topics, right? So, I mean, broadly, I would say my favorite company would be something that is creating real value out there, right? Towards its customers, the employees are happy and they're doing great work, towards its suppliers, towards the whole, let's say, the societal impact it's having, right? And it needs to have the business-based factors too, like the quality, durability, and growth and management and they're all moving in the positive direction. So holistically, that would be my favorite company characteristics and so on, right? So if I just had to pick one company, that's one of my favorite company, not necessarily a stock, not a favorite stock or not a favorite recommendation or anything, I'd pick Costco, right? Because it's a simple enough business model and their whole business is built on saying that we want to provide the best value to our consumers ever since they started and from the days of Jim Senegal to until now, right? So everything, their strategy, their business model, their whole employee culture, their supplier relationships, their consumer relationships, customer relationships, everything is built on we need to provide value. What can we do? And then grow the company out from that perspective, right? Instead of we want to make 20% margins and so on, and let's charge whatever it is up to be. Uh, and I just put in there tangible because when you actually invest in companies that you can really see out there, let's say Costco or Starbucks or Chipotle or Disney, right? And you've been invested in them for 5-10 years and they are giving you good gains, right? And when you actually are in those, when you actually go to those stores and see the people obviously buying a lot from them, so that's a different, very non-financial, tangible, but shareholder feeling that you get, right? Again, this is not necessarily a recommendation for those companies, but you could buy a software B2B business and you could have huge gains in there, right? Which should be, but the same gains in a actual out there in the real world companies, those are something different and something really valuable, right? But again, I don't invest in them for that purpose, right? But I invest in them for the actual investable characteristics of it. But I'm just saying, you get some additional extra happiness when you are in those actually buying from those businesses and inside those. So again, as I said, I turned a lot more growth focused in the last few years, right? So, but there's always this argument about growth versus value, right? It's a huge argument. I don't try to look at it so isolated, right? So again, from few broad principles, I'd say that if you buy something good for cheap value, of course, your gain of percentage would be higher, which is always good, right? So yeah, the value component is there, right? But the value should have, when we're getting attracted to value, we need to make sure that the intrinsic value is there and it is growing. So one sort of picture I try to have in my mind is melting ice cubes versus rolling snowballs, right? So you know the picture of the snowball, it's up top near the mountain, it's really small. As it rolls down, it gets really big. You know, the melting ice cube in a hot sun, you know what happens to that over time, right? So anytime I get attracted to this in a business, as I said, initially I used to get attracted to value traps, right? So where the value is melting away because there is an actual problem with the business, right? Whether or not we understand. And so if you understand what is the problem and if you understand why and what is a catalyst and is the management capable of converting, that's a lot of ifs. And I'm not as interested in those scenarios you don't want that much mental workout on an investment thesis, right? It's much better for individual investors, but long-term investors to be on the other side of the snowballs, right? So there is a huge mountain, let's say, which is like a growth trend, sustainable trend, right? Everybody's going to move toward the 20, 30 years, let's say e-commerce or fintech or something, right? So all you need is good ideas, which companies are rolling, what is the runway ahead of them, and what is the management capability and execution of them, right? If you clearly identify, you don't need to be the earliest investor, right? As long as there's plenty of growth left ahead, right? But you always need to appreciate the value part of it, saying that, okay, do you have a rough idea about the intrinsic value of the business, right? And the stock price might look pretty expensive, let's say enterprise value to sales of 20, right? But if you are confident about the business, if you are understand about the runway of the business, and you are clearly able to see 3-5 years out, for you it might look different or very different and cheap. Whereas for somebody else who doesn't understand the business and just looking at the valuation ratios and saying it's expensive. So it's important to understand where you're coming from, your level of interpretation, and what you're expecting, right? So coming to some of the winners and losers and lessons. So I always try to take a historical perspective, right? So your ideal business should be, once you have your strategy as a personal investor or professional, your strategy and your goals and stuff, right? I really want to do most of your work initially, let's say 80%, and the 20% should be low maintenance ongoing work. Let me give you an example, right? Let's say I got invested in Visa and stuff back in 2009. Visa became public in 2008. I think maybe adjusted around $10, split adjusted in today's terms. And it came to the same price back in early 2009, right? So, of course, did I have a huge 10-slide thesis on Visa? Not necessarily, right? I mean, of course, I was coming from the principles of Peter Lynch, buy what you know, and Buffett's and stuff, right? So it wasn't that difficult to identify Visa as a good business, right? But from my thesis standpoint, what I thought was, okay, the United States might be more mature in using credit cards and debit cards, right? But still, there's a lot of growth left in the United States. But the rest of the world, there's a huge opportunity, right? Multi-decade opportunity, right? So everything from transactions, online payments, obviously online payments has to be made with the credit card, at least at the time, and the cross-border volume and all that, right? So the thesis from then in the last 11 years hasn't evolved, right? I did some work back then, and I try to follow what the management is saying, what the trends are. I don't want to do the whole investigation again and again. So You want to identify those sorts of businesses which are really good, which has tons of road ahead, and you'll have to do less maintenance, right? Because the management is taking care of it and the moat is there and the results are there and so on. So those are very low maintenance, but could be huge compounders when you hold them for 10, 15, 20 years, as long as they have a better future ahead, right? Let's say some of the more volatile ones, right? Like I had similar thing into surgical holding since 2009. I added it only a couple of times, and Mercado Libre since 2014, which I haven't added, which is a big mistake. But I will go into that more, right? So again, the thesis is important, right? Let's say into surgical, right? What my thesis was, right? Okay, this is it started back in late 90s and started 2000. It got the FDA approval into a couple of procedures. So it's a minimal invasive surgery, robotic surgery, right? And 2000s were the first decade, right? And when I looked at it, it was already profitable, which is a huge deal. And there's hardly any debt on there. It's pretty much a debt-free company. The margins are huge, right? And so, what is the thesis going forward, right? Okay, and you have to understand few important factors, right? You got these huge, expensive machines. What is everybody getting out of it, right? The company, obviously, the sales, and also once they sell that machine, they have that maintenance services, and they have this accessories and instrument services and so on, right? So the more machines they sell, uh, the recurring revenue could even get higher, right? Because those machines need to be maintained. They need more instruments and accessories for each procedure and so on. So from the company side, that's going on. What are the hospitals getting out of it? They are spending a lot of money, right? So they need to make sure that they are actually it is a good machine. They wouldn't buy it otherwise, but and they want to use a lot of it, right? They want to increase its utilization, and maybe if that catches up, they want to buy another machine if the results are showing up, right? Again, which is very beneficial for the company. And what are the doctors getting out of it, right? And so obviously, if first of all, if you understand the patient perspective, right? Let's say the patient perspective, which is the most important one, right? So you have, let's say you have lesser blood loss, you have lesser scars, you have less incisions, and you have faster outcomes, faster recovery. That is the thesis, right? As long as it's playing out, which is great for the patient, and then same for the doctors, right? For the doctors, they're also constantly tinkering with the machines, right? They will want to see how else they can use it, and that's a lot of valuable data which they'll provide the company, and but the company can get into more procedures, develop their systems better, and so on, right? So before we get into financial statements, before valuation and all that stuff, you have to understand this part, right? So what are the benefits of the robotic surgery? What is this company bringing to the table? What are the main parties, which is the patient, hospitals, doctors? So if that story is intact and getting bigger and better, that's when it will get reflected in the financial statements, right? So, right. And yeah, I just include this because this isn't as smooth of as a thesis as Visa, right? And if you look at the stock chart for Visa from 2009 to 2020, it'll look like just a straight line up and to the right with very few bumps in between. Of course, we all tell it, but the stock like Intuitive Surgical or Mercado Libre will look different, right? They'll have multiple drawdowns of 30-40%. And when you hold it for such a long term, you will run into bumps, right? Back in 2013 and 2014, there were a lot of questions on efficacy of the Intuitive Surgical machines and a lot of negative publicity. So just like what Abiomed is going now, right? So the outcome might not be the same in every scenario, but the company has to prove themselves to the media, to the healthcare world again. And during that time, there's a lot of volatility, sometimes in the business results and in the stock too, right? And once it recovered again, starting 2015, I think the last 5 years have been relatively smooth from a business performance perspective and even to the stock perspective. Similarly for Mercado Libre, right? I mean, the thesis is not that hard. Again, I got interested in it in 2008. It already fell from its post IPO price high from $70 to I think $12 or something was when I got interested in the company, $12, and it went down as low as $8. But again, I didn't buy that during for the financial crisis. I was buying other companies, so I was still monitoring. It was still pretty high in my watch list. And from 2009 to 14, I did the same mistake, saying that, okay, I either have something else to buy, or this company is priced too high, right, based on its backward looking financials, right? And again, this is a process of evaluation. If I know what I know now, obviously that's not what I knew back then. So you cannot beat yourself up. It's a constant game of evolution, right? So Mercado Libre back in 2014, that's when I finally decided, okay, I understand the picture now, because the main thing is, especially back then, let's say it is a $3 or $4 billion company, right? Back in 2015, maybe it was at 60 to $80 back then. So at the time, again, my thesis and my investment philosophy changed, and as I said, it needs to you need to think as much as about the future too, as much as you're thinking about the past history, right? For some companies, the past financials and operations are a good reflection of what's going to happen in the future, but for many companies, it might not be, right? So you need to be always thinking forward. So that's when I finally got invested in Mercado Libre, right? Saying that, okay, again, simple thesis, it is the Amazon, eBay, PayPal, whatever of Latin America. It's the dominant one for the last 10 years, and it's going to continue. Amazon is always going to make incursions or some other incursions, but these guys have a huge lead and a local market knowledge, especially it's not just in one country, they're in like 13 or 14 countries, with Brazil, Argentina, Mexico being the most important ones. But you need to understand that part, right? So the management is still at the helm. They have this operating history, and they know what they're investing, and they're investing in the fintech part of it. They're investing in the logistics part of it. Some of these were really early information back in 2014, 15, but at least the e-commerce itself was big enough thesis for me to get invested. Again, after you get invested, right, when you're holding for 5, 10 years, there'll be a lot of bumps along the way. For Mercado Libre, the constant issue is the political other social issues going on in the countries, because it's not just one country, it's 13 or 14 different countries, of course. 3 or 4 countries are always going through some sort of turmoil, right? So they'll have a impact, and that will reflect again in the currency devaluation and so on. So for Mercado Libre, that was always a constant pain point, saying that, okay, in constant dollar terms, how much did it, what are the financials, local currency, what are the financials, when does it make sense to put so much focus on the currency conversions, and when do you need to put more focus on the future and the execution and so on, right? So yeah, and Lululemon, again, I don't want to go too much, but again, same thing. Lululemon, I think it was about 60, $70 back in 2007 after its post IPO bump, and it fell down to $4, right? From 70 to 4, which is like a close to 90% haircut. And same thing. Why did it fall 80%? Does it? I mean, it is at the time. It's a very early niche type of company, but it's hyper profitable, not no debt and stuff. But yeah, maybe it was expensive before the financial crisis, but should it fall 80, 90% and so on? So I only bought some, again, that was just when you're starting your investing journey, right? So your amount of capital would be obviously low, right? I invested some at $4, and immediately it went down to $2. Again, this is split adjusted terms, right? And of course, I didn't do anything. I know that why would the company stop going down or crashing right after you buy? It's a huge financial crisis. Everything will go down, right? I didn't necessarily buy, but I was just holding, right? And back to 2010, from 4, it went to $40, and like, okay, uh, I wanted to sell most of it, right? Again, 10 bagger in 1 or 2 years is huge, but I understand it's because of the market. The company might or might not have caught up so much. But again, I sold most of it, but I wanted to keep the rest, right? And again, when the company executes, right, it could be a small player, let's say a Lululemon or a Monster beverage in the growth phase. It could be a very small market, but there could be huge runway ahead of them. Is what is more important than what you bought it at, or whether. Again, I made mistakes with each of these. Investing back then was good, but I should have added to some of these much along the way. But the amount of capital is finite. You always have some other ideas, and based on what else is going on in other companies, the capital gets diverted there. So I don't try to beat myself up on it. I just take the lesson and see how it can evolve. So coming to the loser side, which is more important and which could be more useful for other people, right? I was lucky to say that most of my losers, let's say five or six, which is, as I said, as my quality criteria went up, the number of eventual losers went down, and which is a really fortunate thing, right? So most of these losers were back from then when I bought purely focused on valuation and didn't have a good understanding of the factors. So I was lucky to say that most of these losers, which are Transocean and Seadrill, which are both an offshore drilling business, and ArcelorMittal, which is a steel business, all of these are commodity related, right? So if I was picking a bunch of losers in all different sectors, that's when I would be more concerned of why I was doing individual stock picking. But at least they are all in commodity sectors, and these were invested many years ago and sold most of these many years ago. So I took my lesson. And again, some of these are not hard lessons, right? Let's say uh, the lesson I took away was commodity prices, right? I mean, the company cannot control its own destiny, right? And let's say it's much different from e-commerce or tech business, or even let's say consumer business, right? But in commodity, your revenue depends upon the commodity prices, and you usually have huge customer concentration, right? And when they always go through the supply demand issues, and when that happens, the customers will either cut down buying from you and so on. You have these inventory issues, and most of these are hugely leveraged to the tilt in their balance sheets. And so when the cycle turns, yes, so there's price wars and all sorts of issues. So as a personal investor from my choice, I was like, I decided I don't need all these headaches, but I didn't necessarily know this back many years ago, right? So it's much easier to go to places where constant value is being created with good products, and where the companies can control their own destiny, their own pricing power. They have huge customer diversity and so on, right? Again, I wouldn't necessarily I would never invest in commodity. I wouldn't say that, because there could be few commodity companies, and suppose something at the bottom of the cycle, maybe there's a valuation driven opportunity somewhere, but I wouldn't necessarily allocate a meaningful amount, and it could be just small amount as a short term and so on. Similarly, for long term leaps, I used to do back in 2012. I didn't necessarily swear off it. I would never do leaps because the concept was good, but the market timing, of course, uh, might not have been appropriate and so on. So when you take away the lessons, yeah, I mean, like the snake bite definitely or you get into a market and it falls down 50%, you get out of the market and say that I would never invest in the stock market. I mean, those sorts of hard lessons are not necessarily good over the long term. Right? You have to make sure you're aware of what the situation is, and how to evolve with what is going on. So yeah, I don't know if you had more
So
questions on any specific.
one takeaway from my point of view is you mentioning you got into Lululemon at 4 and then you sold at 40. Do you still think like selling your winners much earlier is much more impactful compared to selling out your losers?
Definitely. If I knew what I knew now, it's a so let's say you have the big winner, right? It's always a matter of what is the current expected outlook for that, right? Based on the current valuation, do you expect it to go a lot more? And that depends on what is the future ahead of this business, right? And also you have opportunity cost, right? And maybe if it went up to too high of a portfolio limit, maybe you don't want to take that much risk in one business. Maybe you trim a little bit and so on, right? But yeah, personally, if it's still 10%, it's executing great, I would have no problem getting it to 20, 25%, or even 30% and so on, right? But if it's giving that much concern to me, I would rather trim instead of getting out of the whole business. Again, if the future opportunity is there. Or maybe you have limited capital, you don't have any other capital coming in, and you have find a much more attractive business, and you don't have anything else to sell other than this. That's one scenario again I would trim. But yes, over the long term, that's definitely one of the biggest lessons I take away. On the loser side, again, if I had a good thesis for what would cause me to sell these companies, and use the actual facts, objective facts, as thesis evaluation rather than a price determination of anchoring to all sorts of different stock prices, right? That's when you can make a decision quicker. Get the correct facts, adjust your thesis, and make the decision. That is And as I said, yeah, coming to selling some of the winners, yes, definitely. I had a thread many months ago when I mentioned Nvidia and Netflix and Microsoft and Costco and so on. I'll just go over 2 minutes on that. So that's one very clear scenario where I completely violated the initial thesis and the selling thesis, right? Nvidia is a different factor. I bought it again at around $8 because I want a hardware company back in during the financial crisis, right? And I was following at the time they had the Tegra processors and so on. This is from 2008 to 2014. These 6 long years, and the stock only went up from $8 to $14. So that's like a 60% depreciation. Okay, the market, but not much. And I got bored of it, right? Saying that it is a good company, a hardware company, but they have they have good margins and no debt and so on. They are in a lot of these good businesses, but why aren't the financial results catching up, right? But I should have done more research on what is coming up at the time, is what the data centers was evolving and the gaming part of it, and autonomous cars. Maybe it was few years down the road, but I didn't even do that. Any sort of analysis. I was like, I got this for 6 years. It only gave me 60% and nothing much happening. And I got bored and I just sold it, right? And look at the next 6 years from 2014 to 2016, it gone up like 6,000% if I had my cost basis, right? Which is a huge lesson. I just, again, that's one example I took away. But the worst of examples are what I had with the Microsoft and Netflix. So by this time, when I invested in them in 2015 and 2016, I already had my current process of how I analyze the businesses, right? Good businesses, long term, don't sell them just for valuation. I had that thesis. So simple thesis where Microsoft, when Satya Nadella came in 2013-14, it was already showing the Azure and the cloud traction. So it was at $40 in 2014 or 15, I think, and $40 was a good entry point, right? And we'll remember that. And same thing for Netflix, had a huge international expansion in early 2016. So I was interested in Gardner around $80, right? So fast forward to 2017, early 2017, this is after the 2016 election, and markets had a huge rally, right? Let's say in December 2016, Jan and Feb 2017, right? And I was concerned about the market levels and I wanted to sell some stuff. And what should you be doing ideally when you want to sell some stuff? Look at your losers and again do the fundamental analysis. And if it's not picking up, you should sell it, right? I went to the winners first. I wanted to capture those gains, and I didn't have any good reasons to sell each of those. So I tried very hard to come up with reasons to sell. So for Netflix, I came up with the reason saying that, okay, the new government might put net neutrality rules, so it might be bad for Netflix. So that is the reason I'm selling. For Microsoft, saying that, okay, this is already a 700 billion, maybe $600-700 billion. How big can it be? That is the reason. Again, these are completely made up reasons and completely went up against my initial thesis. I should not have, but I just tried to validate myself and I sold them, right? Again, obviously that's how we miss 400-500% more gains. Again, lesson learned, right? But it didn't necessarily, these are only the 2 or 3 companies I sold, while I still kept the other 15, 20, 30 other companies, right? Which, but you always, as I said, there's no purpose in beating yourself down. Just learn what you can and make your process better.
Right. And I can tell you, I have done similar things in my investing journey as well, like coming up with reasons which doesn't make sense when you look back like 3, 4, 5 years.
Absolutely. And those are some of the best lessons we learned from
Yep.
David Gardner and some of the other folks, right?
Yep. So let's move on to the next section where, like, if the markets were to shut down for the next 5 years, which one stock would you be willing to own and why?
Yes, it is actually, this is a very good question on how we should be thinking, right? Like Warren
Yes.
Buffett says, if it shuts down, what are the companies you follow? Because that will let you focus on the actual businesses and the business drivers and how they are going to increase that intrinsic value in a long period, 3-5 years periods, right? Because you need to force yourself to this question, which to make good investing decisions, right? again, most of my positions, as I said, is thought out from a similar perspective, especially when you're focusing on quality for the long term. Uh, so you want to hold them for a long time. But the main thing I would say is, even if the market shut down for such an extended period of time, I wouldn't mind holding any of these. But the main thing is, as long as the competitive factors on the quality and the management is still there. Let's say these factors are still the same or better 5 years down the road, right? And that is what we want. And of course, capitalism is too dynamic and things change, but at least we need to make those decisions, right? So from that perspective, let's say the competitive strength of the business is still going to be there 5 years down the road. Management is still going to be there. The opportunity set is still going to be there. Yeah, one of my favorite companies I'd say is Mercado Libre is great because they still have it depends on the e-commerce penetration in Latin America and their fintech mobile wallet and all that payments penetration there. Uh, so it's good actually for some of these stocks, right? Let's say if you imagine the scenario where they don't trade as much, right? Because there's constant currency induced volatility in this and constant quarterly earnings surprises, disappointments, and huge variations of the stock price. But if you imagine yourself 5 years down the road, will a company that doesn't have a balance sheet risk but has much opportunities with direct management, obviously they'll be much bigger, right? The intrinsic value, let's say, respect of the stock price, right? And that's a good mindset to force yourself into, where you will come up with a list of really good, durable, and high quality companies. Right? Similarly, for Intuitive Surgical will be great. Again, there's evolving competition from either Johnson and Johnson, Medtronic, or some of the other smaller robotic companies. But again, these guys have a huge 20-year lead, and they have all the data from the doctors who are using it and so on. So I would expect that advantage to hold. And if somebody forced me to really, again, this is a balance of between what is the opportunity versus stability versus quality, right? Even Amazon is obviously a great company. There might be some risk from the regulation, but ideally, even when you break the company apart, the retail is obviously hugely valuable, and AWS is enormous, and the logistics and other businesses are great too. So, and Visa and Mastercard, again, there's going to be some you just need to watch out for what is evolving on the blockchain side of it, and of course, are those new technologies, can they be adapted or incorporated by the Visa and Mastercard to keep their hold on the payments network and so on, right? So once you think about on those 3 or 5 year lines, you'll get to decide what are the really important factors and which sort of business you have confidence in. And let's say the market goes down like a COVID style 30-40%. Some of these businesses you will have more confidence in holding on to them or maybe even adding them.
Right. Yep. I agree on all of those points, and I own Mercado Libre and Amazon from this list. I used to own a few others, and I have since then moved on from a few of these. But I had done a lot of research on Intuitive Surgical as well, very high quality business, and yeah, like very sticky business, as you mentioned multiple times. Um, yeah. All right. So moving on, do you have any book recommendations for the listeners? If you have
Mhm.
one book that you want to talk about, and give us some key takeaways from that book, and also like why do you recommend that book in particular?
Yeah, definitely. This is one of my favorite topics, right? I mean, there are some great books out there, and for investors to get better, they don't need to read like 30 books or 100 books. They're based on your investing style. There might be 10 or 15 books that are really applicable to you and works out and actually practical, right? So, I mean, as an initial starter book, I would always recommend Peter Lynch's One Upon Wall Street for those who are just getting into the market or who wants to get into the market, right? And understand what's going on. So, as you know, he has a great methodology in the book. And some of his lessons are really simple. The main takeaway is, okay, you don't necessarily need to have an MBA or financial background to do good in stocks, but you need to put in a lot of work, right? You need to clearly understand why you want to invest in individual businesses, why you're investing in this particular businesses, and what you expect from it, and then understand how to read financial statements and valuation and so on, right? But at least the book will empower the very initial those beginners to understand that, hey, this, even if I don't have an academic degree or an actual career experience from it, I can learn this stuff if I put in the time and effort. And these are the stuff I need to look at. So that's a great starting book for I'd recommend for most folks. Uh, the next ones are Pat Dorsey has two books, The Five Rules for Successful Stock Investing and Little Book That Builds Wealth. So I read these books pretty late too, just in the last few years, right? Because I didn't necessarily come across that literature before. But these are some, uh, especially the Five Rules for Successful Stock Investing. That is a fantastic book because once you get the basics, maybe once you have 1 or 2 years experience in the market, but you have to have a more uh, better framework and better approach and how to look at the specifics. So this will look at modes, right? How to analyze the modes and how they come into picture in different industries and how we evaluate different industries, how to interpret the financial statements of different industries. So this book is a great and practical books. I think both of them for investors who has little experience already behind them. And again, I'm saying I'm just you asked about one book. I'm just listing five books, but because I want to give more context on what my favorite recommendations are and for what types of investors. Right. So the third one, my favorite is The Intelligent Investor, obviously from Benjamin Graham. The main takeaways is for me was okay, thinking about intrinsic value, the concept of intrinsic value, and the margin of safety. Again, don't take it. Some of it might not be too applicable in today's markets and stuff, but the core principles are there, right? The interest, every business is supposed to have an intrinsic value, whether or not you're able to calculate it. And the more margin of safety you buy it with respect to the intrinsic value, the better your return will be. Whether or not you'll be able to get it, the price is a different matter. And the Mr. Market analogy, right? The most important one and the most important one I use is the Mr. Market analogy, right? So let's say during the COVID time, right? Nobody expected the markets will go down so fast in 37% or so in a month, right? But when things are coming crashing around you, right? I mean, those are the periods that will differentiate your long-term results, what you do, and from other investors too, right? How calm you can remain during those periods, how objectively you can look at the facts, actual facts, instead of looking at the numbers and the headlines and stuff, right? So this, what this Mr. Market says is, okay, the overall stock market is imagined as an individual that shows up at your door. Some days he's quite happy when the markets are at all-time high and he wants to buy your business at high prices. And in other days, like when the markets are crashing, he is in a very bad mood and he wants to sell away everything that he has, which might be good for you. So once you get that analogy into your head, it can be really beneficial, especially during the volatile times, right? How you can maintain your calm and take action. That is good for your actual long-term portfolio strategy. The next one is Clayton Christensen's huge, enormously influential book, The Innovator's Dilemma, right? Especially if you're invested in growth and future-oriented businesses, this is a must-read book. The book could look boring initially, but once you start getting those ideas into your brain, because it'll talk about how innovation and disruption affects businesses, right? What does it do to the businesses that are on the cutting edge? Let's say in Netflix in late 2000s, right? On the cutting edge, how it was using technology, right, to offer what consumers want. That is what it's doing, right? If the technology enables it to give it on DVDs, it will give it on DVDs. If it's on streaming, it will give it on streaming. So whatever is the next evolving step. At the flip side, what are the effects on the business that are not adapting to it? Let's say Blockbuster and all those businesses, right? Or even let's say BlackBerry back then. What happens inside those companies, right? How does the management react? Even when they know the oncoming threats, why can't they react? Because they don't want to kill their current cash flows and so on. So the takeaways from the book are enormously useful because it'll puts you in perspective of the growth companies, why they're investing and how they're creating value, even if that's not currently reflected in the financial statements, and how that is impacting the businesses that are going down. They might look cheap on a backward-looking basis, but how their eventual future value will keep diminishing and so on. So that's an excellent book. And the last one I'd recommend is 100 Baggers by Chris Mayer. And many people might be familiar with this book. Again, it'll tell a few main things, right? When you buy companies, when they're smaller, right? But they're great companies with a long runway ahead of them. And if you're lucky enough to get them at a cheap valuation, how that will lead you to 10 baggers, and eventually, if you're lucky enough in some of those picks, and if you hold them long enough, how they can be 100 baggers. Again, this is not necessarily to get tempted by trying to get 100 baggers and stretching yourself and making risky picks, but it's saying, like Peter Lynch's book, it's to encourage individual investors or investors out there to say what are the possibilities that can happen when you have a long enough time frame and you have you make good decisions in investing in quality businesses at good valuations. So yeah, those are my 5 overall book recommendations. As I said, it'll apply to various folks based on what they want to get out.
That was great. So do you have any final thoughts, and do you have any advice for the new investors tuning into our podcast?
Definitely. Again, I try to tilt most of these lessons shared during this podcast towards the newer investors who are starting out and want to put in the effort and time to learn more and get better at investing, right? So a few things. I mean, obviously for majority of people, they have limited time. Of course, they have their career, they have their social life and family life and all that stuff, right? So you have very limited time. For most of those people, usually the low cost, well diversified indexing applies and is the best choice, right? So if somebody is saying that, okay, I want to invest in individual stocks also, right? So they need to think, okay, why? Because when you have a safer route but very limited time, why do you want to take that extra effort of trying to research individual stocks and then trying to deal with individual stock prices? And yeah, there's a lot more follow up that you need to do and stuff, right? So that's when you have to think about, okay, what are your strengths, right? So you need to, for you to hold individual stocks, especially for the long term. I'm not talking about other types of trading and momentum, but individual investing in long-term businesses, you need to think what your strengths are, right? Either information is no longer an advantage, right? Everybody has it at their fingertips at the moment. So what unique insights do you have? Maybe you work in that industry or adjacent industries, you know that, okay, that could be very valuable, right? Or very normal thesis, but you can hold it for a very long time. Let's say if you invested in Amazon during the simple thesis back in 2005, 2010, even 2015, right? Saying that, okay, e-commerce is the future. Amazon is the best company in there. It could be as simple as that for people, but there's one Amazon, there's multiple failures in other companies and so on, right? But what I'm saying is, either you can have differentiated insights and gain a lot, or you can have a decent enough insights and hold it for a very long term, and some of those picks will return huge. I'd say. So again, when somebody going to the individual stock investing side, they need to figure out their goals, strengths, and what are the actual strategies, and they need to line up, right? Let's say you are you decide to be a long-term investor. Don't invest in a company which doesn't have a long-term future, or you don't understand anything about it, or it's not competitive, strength isn't there, and so on, right? So decide what each individual investor need to decide. If it's trading, are they good at trading? Are they good at momentum versus long term? Are they putting the actual time and effort to improve on those lines, right? And I'd say continuously learn, be curious. If you have the time and effort, you are putting into it. So obviously there are a few great books, and there's tons of blogs and Substack out there, right, that are shared on Twitter and elsewhere. And this podcast, I'd say, is like the golden period of podcasting, right? No matter what topic you're interested in, and it applies as well to investing too. There's tons of good podcasts. Just research on them and start listening. If you like a couple of episodes, subscribe and follow, I guess. And also, yeah, if you're trying to go for concentrated positions, you do analyze those companies, the source documents itself, right? The 10Ks, financial statements, and how to understand them and interpret them and so on, right? But always remember, yeah, no matter what you hear from Twitter or blogs or anywhere, YouTube videos, make sure once you learn, you're making your own decision. You're constantly putting that time and effort to improve the process, right? And stay within that circle of competence, which is always important, right? And don't hardly anybody is expert enough to invest in with confidence in 10 different industries, right? Maybe two, three different industries, but always try to expand that circle of confidence over time. And this is the process that helped me, the flow. Always look at the businesses first and the financial statements next and the behavioral side of it next, right? So getting attracted to business when because of the financial statements, when the actual business lacks a strength, isn't going to help. So businesses, financial statements, and behavior, that's the order I go in. And always expect volatility and accept it and plan for it. It's a given, it will repeat itself numerous times over your investing career. Don't just be surprised by it. And obviously it's a great time to learn, but also there's a lot of noise out there, right? So learn to focus and filter out the noise. And patience is something that cannot be taught by anybody else. Investors need to develop it themselves. But overall, keep learning and enjoying the journey, and the results will follow. And just share what you learn. That would be my last advice.
And that's phenomenal advice. Thank you, Ram. Like, if I would have these points right in front of me when I began investing, I would have been like a much better investor. But we always start from somewhere. And I really appreciate you sharing all this advice for any investors tuning into our podcast.
Yeah, my
Um,
pleasure, my pleasure. But yeah, everybody needs to go through their own journey, right? But the benefit of now is you have so much sharing going on online and stuff, and somebody who can focus and want to learn, they have that information at their fingertips, which
mhm.
is a great thing. And
Right. So the last thing, what we always do on our podcast would be to give a shout out for Twitter accounts. And today I am going to give a shout out to the Stock Novice. His Twitter handle is at Stock Novice, and his Substack is thestocknovice.substack.com. And I have been following him since last couple of years, first from the Motley Fool boards, and now uh, through Twitter. And he posts month end portfolio reviews. He runs a very concentrated portfolio, and he has pretty good posts on portfolio management. So be sure to follow him. His Twitter handle, once again, is at Stock Novice. And that would do it for this episode. Thank you, Ram. Thank you very much. I really appreciate you being here and sharing your journey and all the insights and all your advice with all our listeners.
my pleasure, Dhaval. Thank you for having me.